Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In this video, we're going to take a look at how to think about dividends once you retire. It's a very popular approach to retirement. The idea is if you just spend the dividends, and I suppose whatever interest we might get from bonds, you can never run out of money. It's a very safe feeling to never have to sell shares. It comes up a lot in different forums and different articles. I even see the idea in mainstream media like the Wall Street Journal. And so here's what we're going to do. We're going to look at 6 things. The first is, for the first 4 things are, I won't call them problems with the idea of living off of dividends, but at least 4 things for you to think about before you take that approach. Then we're going to look at the idea of total return and why I think personally that's sort of the better metric to focus on over and above dividends. And then finally, I am going to give you some ideas of how you might, if you want to, increase the dividend yield on a portfolio in a sort of safe way. And so that's what we're going to do. So let's get right to it. And the very first problem is that dividend yields are extremely low today. Let me give you some examples. We are looking at M1 Finance. This is the 60-40 portfolio. I did a video on this just a week ago. And you can see it consists down here, you can see it, the S&P 500. This happens to be a Vanguard ETF and total bond market fund. And we can see the yield. It's right here. It's 1.653%. From the S&P 500, it's about 1.3. You can see that there. And then we get more than that from the bond fund, 2.18. And when you mix all that together in a 60-40 portfolio, that's where we get, well, we'll round up. We'll call it 1.7%. And that's problem number 1. For many retirees, it's extremely difficult to live off of that kind of yield. Most folks can't live off 1.7% as sort of the initial starting spending rate. If you have $1 million, it's only $17,000 in year 1 of retirement. And most people just can't do that. Now, yes, we can look at ways to increase this yield. That's what we'll get to at the end of the video. But if we're going to have a portfolio that sort of just mimics the market, right now dividend yields and bond yields are so low that I think for most people, it's just not practical. That's the first problem. The second problem is sort of kind of in a way the opposite problem. There may be some of you that can live on 1.7% as an initial spending rate in retirement. Maybe you can. You've got some Social Security. Maybe you've got a pension. And, you know, if you had to, you could live on that dividend yield. The problem there is, potential problem, is that you're likely to significantly underspend what you otherwise could have spent. Remember the work that Bill Bengen did, the 4% rule. You can really pretty safely start with 4%. Some even today might even say 4.5%, maybe, depending on your portfolio, as an initial spending rate. Now, again, some of you might say, look, at 1.7%, I'm perfectly fine. I don't want to spend another dime. But if that's not you, and even if you could live on that, but you'd like to live on more, if you just focus on the dividends and the interest from the bonds, you're likely to significantly underspend what you could have otherwise spent. I suppose that's good for anyone you leave your money to when you die, or perhaps charities, but you're likely to have a truckload of money 30, 40 years from now if you stay at that spending rate. So that's problem 2. Just focusing on yield, you could end up living a lifestyle in retirement that's significantly below what you otherwise could have enjoyed. All right. Problem number 3, this is really important, and I don't think it's focused on very much in a lot of circles, and that is that dividends can and do go down. And I'll show you an example of that. We're going to go over to Portfolio Visualizer, and we're going to be looking at a number of things here today. But what I've started with is a $1 million portfolio, assumed an initial withdrawal of $40,000, adjusted for inflation. The withdrawal comes out annually. You can see that there. And I'm going to display the income. So I've marked this as yes. So that will actually show us year by year how much, either in dividends, if it's a stock, or interest in bonds, the investments generate. And what we're going to look at is just one portfolio that's 100% SPY, which is the SPDR S&P 500 index fund. And I've already analyzed it. This goes back to 1994. Now, the first thing to note is if you retired then with $1 million and you started using the 4% rule, today you've got $8.5 million. And that's after what, 26 years. That's pretty good. If we go down to income, this is total returns each year. Here's the income, portfolio income, right? And you can see starting in 94, most years it goes up, which is good, right? But not every year. This one was pretty close, but it went up a couple $100. But then from 2000 to 2001, it went from, we'll call it 31,000, just under, to 29,000. So if we were living on the dividends in 2001, we would have to cut back, right? We have to scale back. Now, the good news here is it went back up and it kept going up. But when we get to 2008, we're at 53,600, and the next year it just falls right off a cliff. Of course, this was the Great Recession, but it drops to $42,000. And in fact, it doesn't go above 53,000 until 2012. So it takes us a while to catch back up. And that's the thing that I think a lot of folks miss with living on dividends. If you think about the 4% rule, the 4% applies in year one of retirement. You get 4% of whatever you've got invested. But after that, the 4% goes out the window. It's irrelevant. What happens beginning in year two, if you're following that kind of distribution model in retirement, is whatever you got last year simply gets increased by the rate of inflation, or I suppose decreased if there's deflation. But the 4%, or the yield, if you will, the percentage, no longer matters after the first year. You're just adjusting for inflation. If we're going to just spend our dividends and our interest in bonds, we have to recognize that while most years we're probably going to see an increase, in some years it's going to go down, and it can go down significantly. And I can tell you, even if you focus on like the dividend aristocrats, the companies that have consistently not only paid a dividend, but increased their dividend year after year for at least, well, some say 20, 25 years, depends on what metric you use, but a very long time, they can even go down. I mean, in the 2008 and 9 Great Recession, there were about, I think, 60 companies in that category. I think there are only about half of those that still remain. Now, some of that was because of acquisitions, but many of them either didn't increase their dividend and lost their status that way, or had to suspend their dividend. That was particularly true in financial services. And so, yeah, even the best of the best can have, a cut. And you have to keep that in mind. It can be a very bumpy ride if you're going to try to live on dividends and I suppose interest on bonds as well. So that's the third problem, or at least something to consider before you go down that path. The fourth thing to consider is, and I alluded to this already, if you're living off the dividend, there's no guarantee that the actual amount, the dollars you're going to receive each year, are going to go up by the rate of inflation. Some years they will, some years they won't. We just looked a minute ago at how you can actually have a decrease in your dividend. But even if the dividend goes up, there's no guarantee that it's going to go up by the rate of inflation. Now, when you look at studies and you look at long periods of time, what I have found is that by and large, dividends do go up by the rate of inflation. The problem is, we don't retire over long periods of time and just simply take the average. We have to, for better or worse, we have to live day by day, month by month, and year by year. And there are many, many times when the dividends don't keep up with inflation. And so you just have to be prepared for that. The idea of the 4% rule is that everything is adjusted for inflation. And the idea is it smooths out your spending throughout retirement on an after inflation basis. And frankly, there are pros and cons to that. I'm not convinced that following the 4% rule is necessarily the best way to go. But still, if you're going to live off dividends and I suppose interest on bonds, you have to be prepared not only for those to go down for some periods of time, but even as they go up, perhaps they don't go up by the rate of inflation. All right, so those are sort of the first 4 points that I think you need to think about if you want to try to live off dividends in retirement. Now, let's get to the fifth thing, and that's this idea of total returns versus just focusing on the dividend. So total returns would be the returns that an investment gives you regardless of the source. Normally it would be price appreciation, capital gains, the value of a stock or a fund going up over time, plus dividends, right? And that would be total return. And it's my view that that really should be our focus, really at any point in our investing timeline, but even in retirement. And I want to show you some examples just to give you some things to think about of different investments and how that might work. So let's go back to Portfolio Visualizer. And I want to look at a couple of different investments. So we've got the S&P 500 already plugged in. That's SPY. VYM, let's start with VYM. It's a Vanguard high dividend ETF. Now it's VYM. Let's pop over to M1 Finance and we can look at its yield. So high dividend, it's 2.76. That's a pretty significant difference. Remember, S&P 500 is about 1.3. So the high dividend yield ETF from Vanguard has a dividend payout or dividend yield that's more than twice. So that's pretty significant. And so if we come back to Portfolio Visualizer, let's just compare these two. And again, we're looking now at 2007 to the present, and that's just how much data Portfolio Visualizer has. I didn't pick that date. You can see it right here. That's how far back they have it for that particular ETF. So Portfolio 1 is our S&P 500, Portfolio 2 is our high dividend. And you can see that at least during this time period, the S&P 500 trounced the high dividend yield fund. If we start with $1 million for each, we again do the $40,000 in year one, adjust everything for inflation. We've got 2.1 million left in the S&P 500 portfolio, just 1.6 or 1.7 in the high dividend yield portfolio. And if we come down to the income payouts, again, red is the high dividend yield, right? It pays out more, as we would expect. Its yield's much higher. What that means as a practical matter is that if you invested in the S&P 500, that's the blue bars, you would have had to have sold shares, more shares, each year to live on than you would have had to sell if you had the high dividend fund. And I suppose you might take, you might take comfort in the idea that you don't have to sell as many shares, but boy, that's an awfully expensive comfort, because you've gone from 2.1 million with the S&P 500 down to 1.6. I personally take far more comfort in this number. Now, at this point, you might be saying, well, Rob, you're probably just cherry picking the ETFs. And that's a fair point. So we're going to look at some more. And we're going to start with, this is Schwab, SCHD, that we've looked at this portfolio in past videos. So let's add that to the equation to see how it does. And before we analyze it, let's look at its yield. Again, just jumping over to M1 Finance. So 285, so pretty solid, at least by today's standards. And so how did it do? Now here we can see we've changed the time period. And again, I didn't do that. I'm not cherry picking the time period. This is just when the data is available in Portfolio Visualizer. But if we think about that period, it's roughly a decade, and it's an important one for retirees because that's where the sequence of returns and sequence of inflation risks are the most pronounced, that first decade or so in retirement. And so how'd they do? Well, we come down, and actually the Schwab fund did outperform Vanguard, so that's good. But it didn't beat the S&P 500. Still, the S&P 500 is the king of the road, at least at the moment. We could argue it's not by a lot of money, although I'd certainly prefer to have 3.3 million than just over 3 million. We could look at standard deviation, but it's interesting. They're exactly the same between those two funds. And in fact, Schwab's portfolio had a worse year, still not all that bad, all things considered, but it was certainly or still worse than the S&P 500. And again, if we come down to the income, we can see again, the S&P 500 is got the lowest payouts of all three funds. And in fact, the Schwab one's got the most. And yet it still didn't outperform the S&P 500, which again is, I guess, a visual example of why I think our focus should be total return. Now, one argument in favor of dividends is to say, well, they're more stable, that yes, prices fluctuate more than the dividend itself. And, depending on what data you look at, there may be some argument to that or some validity to it. But when we look at portfolio growth, we don't really see a lot of difference. Of course, the S&P gradually outperforms the other funds, but it's not as if this blue line, which is what the S&P 500 is represented by, drops way down here at some point, well below the other two. In fact, they, to my eye, look pretty highly correlated. So not a huge difference. Now, having said all of that, there are other funds that we can look at, and I want to do that now. and we're going to look at the VIG. So the VIG is the Vanguard Dividend Appreciation Fund. And this one's significant and a good fund. I mean, frankly, all of these funds, I think, are good funds depending on their purpose. But if we look at the VIG, one thing you're going to notice is the yield's much lower than you might expect. Remember, the S&P 500 is 1.3. This is just 1.5. It's not that much more. And here's the deal on that. There's two ways to think about dividend investing. One is to find investments with high yields, right? There you could think of master limited partnerships or REITs or older sort of companies that have just sort of been entrenched in their industry for a long time, like maybe a Verizon. I think it yields around 4.5%. So that's one way to think about dividend investing. Another one is to say, look, let's forget the initial yield. What I really care about is growth in the dividend. And you think about it from a retirement perspective, that would be really important. We want to see that dividend grow. And that's the VIG, V-I-G, this particular fund. They're really looking for companies that grow their dividend. So when we go back to Portfolio Visualizer, so we've got 100% in the VIG, and we analyze it. Now, again, now we're back to 2007. Again, that's just the data they have. And Portfolio 1 is our S&P. Portfolio 2 is our VIG. And look at that. I finally found one that outperformed the S&P 500 over that time period. And it did it. The standard deviation, look, is significantly lower, almost, I guess, two percentage points roughly. Its max drawdown, roughly 9-10% less. Its worst year, 10% less. Yet its compound annual growth rate was more, not by a lot, but still on a risk-adjusted basis, this is terrific. And we've got more money at the end of the day. So here's an example of a fund. It doesn't pay a high yield, as we saw, starts at 1.5, but it's really focused on dividend payers that grow their dividend. And in fact, we can look at the VIG, here we go, in Morningstar, and it's probably, it's a blend fund, but if we look at the portfolio, I'm sure it's tilted towards value. Yeah, so it's right on the value, this is the blue dot. It's in the blend category, at least according to Morningstar, but really close to value. And we can see that it's done really, really well. And that raises the question, well, maybe that's our answer. I mean, maybe we just go with that approach to dividend investing. We don't start with a high yield, but it grows a lot. And I'm not here to say that's a bad approach necessarily, but there's always more to the story. So let's go back to Portfolio Visualizer. And I want to add in one more fund, and it's the VUG. We just changed just one letter. We go from I to U, Vanguard Growth Fund. Let's put that one in there so we can compare all three. And when we do that, here they are. And we're looking at a time period, again, still same time period, January 2007. And look at that. The VUG crushed our S&P 500 and our VIG, our Dividend Appreciation Fund. The VUG, the High Growth Vanguard Fund, just walloped us. Now, its standard deviation is higher for sure, although its max drawdown is actually lower than the S&P 500, and its worst year is only a little over 1% worse. And look at that, almost $3.5 million. And just to add to all of this, if we look up the VUG yield, any guess what the yield is on the Vanguard Growth? 50 basis points, 54 basis points. I mean, it's a paltry yield. And that's because a lot of high growth companies think Alphabet, Tesla, Amazon, they don't pay any dividends. And yet, in this case, without any dividends, or not any, but relatively low dividends, it just trounced the other two. And if we come down here and look at the annual income, we can see, its income, which is this gold bar, or yellow, is significantly below the other two funds every single year, which means, as a practical matter, if you invested in that fund as sort of your main equity fund, and you retired in 2007, you would have sold a lot more shares than your neighbors or friends that invested in these two funds, the S&P 500 or the VIG that focuses on dividend appreciation. And I suppose if you could have this argument about dividends versus total return, but the thing I want to stress is that at the end of the day, in my opinion, total return is what matters, and we shouldn't be petrified of selling shares. What we should be looking to do is, in a safe way, maximizing the total return of our portfolio. And that kind of gets me to the sixth and final point, and that is, if you're still not convinced and you really want to focus on yield, are there ways to safely increase the yield? I think there are, and let's talk about that. So first of all, what do I mean by safely? To me, the safe portfolio is one that just covers the market. We could look at a 60-40 portfolio like we saw in M1 Finance just a minute ago. You could do a 3-fund portfolio that we've talked about in the past. And in fact, I can show you that in M1 Finance. It's right here. It's got a yield of 1.78%, and you can see how it's divided here. We could change these percentages, but it's a 3-fund portfolio. U.S. stocks, international stocks, and then a bond portfolio. To me, that's sort of the safe place to be. You're not betting in favor of value stocks with higher yields. You're not betting in favor of growth stocks with lower yields. You're saying, look, sometimes growth is going to win, and sometimes value is going to win, and I'm just going to be here in the middle. and there could be times when my portfolio doesn't do as well as someone who's focused on growth or someone who's focused on value, but it's sort of the safe place to be. And just to underscore that, I showed you here how, here we go. I showed you here how growth outperformed, but when you look at the chart, you can see a lot of it is in the last 5 or so years, and that's because large cap growth just sort of took off. We can look at a different portfolio, and I'm going to quickly go to looking at it as an asset allocation portfolio. So rather than picking individual ETFs, I'll just compare a sort of U.S. large cap with U.S. large cap value. And I'm going to do this, and you'll see why. So this goes all the way back to 1972. And let's start with $1 million just to make it good. We're not going to take any money out of it at the moment. Oh yeah, we can. Why not? Yeah, we'll withdraw our 40,000, and it's adjusted for inflation just to keep things equal. And you can see our large cap U.S. fund, an S&P 500 effectively, today would have 6.8 million, and our value fund slightly more, $62 million. And you're looking at that and you're thinking, Rob, clearly Portfolio Visualizer's got a math error. Well, they really don't. When we look at this 50-year period, particularly in some of the middle years, value just trounced growth. So the problem with that, though, is, as we know, over the last decade, growth has trounced value. And that's really the problem. Picking winners, picking value over growth, you can do really, really well for some periods of time and very poorly in others, which is why the more I invest, the more I tend to move to the middle. But I promised you that there are ways to think about how you can increase yield safely. And by safely, what I mean is not straying too far from a portfolio that basically covers the market. When I see folks talking about a portfolio that can earn 4, 5, 6, 7%, the only way to do that in today's market is to take your portfolio and highly concentrate it in certain types of investments. And I think that is not safe. I think you're running the real risk of having a total return that significantly underperforms the market. That's my view. Can you tilt it a little bit towards yield and probably be okay? I think so. And let's talk about a couple of ways to do that. So one would be sort of the Paul Merriman approach. And we've talked about Paul, good friend of mine. We've talked about his portfolio, his buy and hold. Here it is. Now, in this case, the yield isn't huge. It's almost 2%, but certainly above the S&P 500, which is 1.3. Why is his yield higher? Well, he does a couple of things. He invests in value funds. You can see here, S&P 500 value. Here's a small cap value. Here's an international value fund, 2 of them actually. And they tend to pay higher yields. He also has a real estate fund, and REITs tend to pay a higher yield. In fact, if we look at this REIT, it's almost 3%. So is this fund tilted away from just sort of a total market portfolio? Absolutely. And are there risks in doing that? Absolutely. But I think this is still a reasonable approach. And one might even argue that it's value's time to shine. The growth has done really well over the last decade, but that's because interest rates are so low. And yes, they've even gone down lower here in the last few weeks, but eventually they're going to start to go up. Eventually we're going to have inflation. And when they do, value should outperform growth. I find that to be a reasonable view of what might happen. Of course, will it happen? I don't know. And if it does, when will it happen? I don't know. But I think this is at least one way to think about a portfolio that has a slightly higher yield that still is very well diversified. Will it outperform just a straight S&P 500 index on the equity side? There's just no way to know. But I don't think this is the kind of portfolio that's so skewed to one side that it would be a high risk portfolio. That's just my opinion. And of course, you could increase this yield even more to some degree by changing the percentages to favor some of the funds that are in this portfolio. Again, though, the more you do that, the more you stray away from the total market, I think the greater risk you are taking. So that's one approach. It's not the only approach. We could look at like what I call the 6-fund portfolio. It's got a yield that's very similar, and yet it doesn't take as many. I would say this is maybe even closer to a total market fund. It's only got one value fund, that's small cap, does have real estate, which has a higher yield, and international stocks and emerging markets, at least today, tend to have a higher yield. The international stock fund, you can see, is almost 2.5%, and emerging markets, not sure, still over 2%. So notably higher than an S&P 500. So this is another way where you could make some changes to, say, a standard S&P 500 kind of fund or portfolio and increase your dividend. Again, I want to stress, though, there's no guarantee that the 6-fund portfolio or the Paul Merriman portfolio is going to outperform just an S&P 500 index fund. So you just have to keep in mind, as you reach for yield, and I don't care if it's by taking credit risk in a bond portfolio with high yield corporate bonds or emerging market debt, or in a stock portfolio reaching for yield for companies and types of equity investments that pay higher yields, there's no free lunch. You're taking risks as you move that portfolio in that direction, and it has the risk of substantially underperforming the market as a whole. At the end of the day, for me, as I now transition into retirement, we're very focused on total return. I don't run away from dividends, and I love my dividends. And I go into personal capital, and I look at the income that my investments are generating, and it's kind of comforting. I'll be the first to admit it. It's nice to see that. But I then have to remind myself that at the end of the day, what really matters, in my opinion, is total return. And so if you're going to reach for yield, you need to be very careful. Well, I hope that helps. I hope you find that helpful in your own construction of your portfolio. If you have any questions, comments, obviously leave them below the video. I'll do my best to respond and help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.